All right, good afternoon, everyone. I hope it's been a good first day of the conference. My name is John Glidden. I'm the Chief Investment Officer for Delta Airlines. We have an expected return of 7 to 8%. I think that probably aligns with a lot of folks in the room, but I got to tell you, we need that 7 to 8%, y'all. So if we've got that, it's good for Delta's beneficiaries, but it's good for Delta's bottom line, both cash flow and earnings. It allows us to do things like sponsor a coffee bar at Global Alts on Wednesday and Thursday, so please go see my friends tomorrow. They'll match status, tell them John sent you. But that 7 to 8%, that just seems hard, right? So we've seen huge returns out of equities the last few years. Earnings yields are abnormally low, dividend yields are abnormally low. It's true that the yield on treasuries is higher than it's been in a while, but we're still talking 4.5% to 5%, a little bit of roll down from a positive yield curve, but that's not going to get 7 to 8. IG spreads are tight. It's tough. It's a tough goal for us allocators out there. CPI plus 5, 8%, 10%. It's tough. So hopefully the panel here today can help out with this quandary that we face. And this is really just going to be a pitch session. I've got 5 panelists next to me here. They're each going to get 3 to 4 minutes, strictly monitored, to kind of pitch an idea. And I will, sprinkle a little bit of Delta flavor as we go through the session. But that's really it. We're going for a pitch session. So Steve, take it away. Well, let me introduce folks first. So we've got Steve Rocco, who is the co-head of Taxable Fixed Income with Lord Abbett. We've got Paul Horvath, who's the CEO and co-founder of Richert Global, which is a private and public credit shop. We've got Richert, who is the co-lead of the CLO platform for Polen Capital. We've got Anthony Kettle, who is a senior PM in emerging market debt with RBC Blue Bay. We know the rules now. Steve, take it away.
Thanks, John. Excited to be here. So just kind of setting the stage on the macro backdrop. At Lord Abbett, we believe we're in a relatively high nominal growth environment. Think 2.5 real, 2.5, 3% inflation. The market environment is somewhat still inflationary, obviously not anywhere close to 2022, but strong enough. And in that backdrop, it favors leverage credit. And within leverage credit, the asset class that we like the best is short high yield. When you think about short high yield, return yield 7.5% to 8% with a 2 duration. When you look at the kind of fundamentals of the index are particularly strong. EBITDA growth, we're projecting about 8% for high yield. The credit quality of the index is very, very strong. You look at double Bs in the index, they're well over 50%. There's not been a lot of triple C issuance. So when you think about the spread that we're getting, it's still tight. We acknowledge it, but in high yield, you're going to earn a return over your default loss. And defaults right now are exceptionally low, sub 1%. And usually you earn an excess return of about 250 basis points over that default loss. So we don't think there's going to be much there. And then projecting forward, you look at something like a distress ratio. There you have, percent of bonds that are trading above 1,000 basis points. In high yield, that's 3%. A good rule of thumb is about 1/3 is in your forward default there. So we think you have a high likelihood of earning that 7.5%. We don't really favor durations. We don't like ag-like products because of the inflationary environment. We want to maximize, our spread duration, but we want to keep that relatively short because you're not getting paid to go out the curve. And we think something like, short high yield can do that. Now, what the risks are, for us, and the big thing for this year, to me, is, how restrictive, is the Fed. We don't think they're restrictive at all, especially after they cut 100 basis points. And so, if they don't, if they don't cut any more, we're actually okay with that, given the macro backdrop. There probably is some probability that we would have under distribution that they could hike in the back half of the year. That would be negative, clearly, for high yield, amongst many other things. But that's not our base case. So I think things will kind of continue on, and the returns will be pretty similar to what we achieved last year, maybe a little bit less, given where we started. Last year we got about 9% in high yield. This year I think we can get about 7.5 to 8.
All right, and in terms of Delta's portfolio, we've got a 3% strategic asset allocation to high yield. And this is the point where I should tell you that Delta, we kind of cheat a little bit. And by that, I mean we're portable alpha investors, so we separate alpha and beta. We think that we can get high yield +3, so we get exposure to high yield by trading swaps either on the iBox or on HYG. You still get SOFR minus, SOFR minus 50 to get HYG. It's still pretty attractive. But then we manage the collateral by working with a lot of the hedge funds that are here at the conference, and we think we can get high yield +3. If you want to get to 7 to 8, anything +3 looks pretty good. All right, Paul, you're up.
Good. Well, thanks, John. It's maybe a good contrast to have the SRT guy go after the high yield guy. A lot of people still don't know what SRT is, but it's gotten a lot of popularity recently. But for us, it's one of the bases upon which we built Orchard Global almost 20 years ago. So the pitch for SRT is pretty simple. You can go into high yield at, what are spreads, 2.5%, 3%, where you can, and that's high yield. So while defaults are low now, expected defaults over a 10-year period are about 2 to 3% per annum expected. Or you can go into SRT, which, while there is a little bit of, there is structural leverage, it's largely investment grade risk or crossover sort of triple B, double B risk. And you can get returns at 5, 6, 7, 8, 9%, 10%, over SOFR. So that's the pitch for, would you rather get 8 or 9% and face potentially 1 or 2% of losses per annum, or would you rather get 10 or 11 or 12 and face something that looks more like 10 or 20 basis points for losses? So that's SRT. It's one of the reasons why so many people are going into it. The pitch for Orchard is that we, and it was really my bosses more than I, created this industry at JP Morgan in the late 90s, early 2000s. But I recognize an opportunity that, with the global financial crisis, banks are going to need that product, SRT. That's why banks want to do it. So we had a solution to the banking crisis in 2007 that the banking system didn't yet realize it had on its hands. So that's the reason we started Orchard. And for investors, well, they can get a good return. Why are we getting better returns than you can get, in the high yield market or emerging markets or even CLO markets? Because unlike all those other markets, the banks are helping subsidize the returns. They're doing it because doing SRT is cheaper for them than issuing equity. So if you take a market spread and you get a subsidy from a bank, you're going to get a higher return and at a risk-adjusted basis. So to finish, so what's the pitch for Orchard? Since we started the firm in 07, 08, we've done about 80 of these transactions, these SRT transactions, with about $175 billion in risk. And our worst performing deal was 7.6%. The best were in the 30s, but the vast majority of the returns are in that 10 to 20% sweet spot. In our biggest fund, the cash yield right now on that is just shy of 17%. And our losses over that $175 billion over all kinds of credit cycles, we've had 19 basis points in defaults, and we've had, but a lot of it's senior secured, so we've had about 5 basis points in recoveries. So that's the pitch for SRT and Orchard, which is why you're seeing a lot of people come into that business. And it was a $27 billion business last year. It's probably going to grow to $30 billion this year, and it should grow by 10 to 20%, if not more, going forward.
All right, Delta has a targeted 10% allocation to private credit. In our world, private credit has 5 buckets, which I'll talk about throughout the panel. One of those buckets is corporate securitized. That's going to include both the SRT business as well as the CLO business. So I know this gets, I'm cutting the tranches pretty fine here, but that's about 2% of Delta's overall plan assets are in SRTs and CLOs, which might be decent transition to Rick.
Thank you very much. So it was 7:15, I'll just say 20. We'll see where this winds up. No, but seriously, yeah, so I think about the landscape of risk assets really interestingly and the way you set it up. Mag 7, 33 PE, S&P 20, all these liquid markets aren't that interesting, and they're say robustly valued. I'm not sure, we want to say fully valued, but they're robustly valued. CLOs, I think, I've been running CLOs 20 years across 3 firms. I think it's one of the best setups in 10 years. And because effectively as the liquid assets mean revert to some normalized spread, it's a little bit of a headwind, right? So, high yield is 8, but if it mean reverts, maybe it's 7, 6. And you could go down. Equity, maybe, instead of 20% returns we've had the last, especially through ZERP, maybe it's, 10 or 8 or 7. CLOs take advantage of that mean reversion. And so effectively you have an asset base at SOFR 320 minus your liability cost of funding at SOFR 170, right? So you're getting paid 15% returns doing nothing, assuming the world stays the same, cash on cash distribution, 15, 15, 15. The beauty of the setup now is that 170 cost of financing is 13-year money, can't be touched. So you're sitting there, you're effectively long a call option on spreads, right? You can't say that about many other products at all. And so you're long this call option. If that 170 stays there, it does, and the 320 goes to 330, 340, 350, 360, whatever it does, mean reverts through some path over your 5-year reinvestment period, you're starting at 15% return. You're likely to get 18, 19, 20. I've done deals that have done 29%. My lowest return ever in my career is 11%. The entire industry has only had 3% of deals in history create a less than 0% IRR. So it's a very robust product, and I think set up very, very nicely right now. Polen Capital is a big firm, been around 30 years, $60 billion in size. We're traditionally based in Boca Raton, and it's traditionally an equity shop, but they bought a credit shop at the end of 2021. So that's what I'm part of. We're based in Boston. The second I got the invite to Miami, I was like, done. So I think it's a really, really compelling asset class, really, really good sort of setup. And if anybody's interested, happy to talk about it more.
All right, so Delta looks at the CLO, kind of space in a couple of different ways. We've had some, decent luck in we've always kind of liked AAA risk. Again, as portable alpha investors, we try to get that synthetically, so we have swapped an ETF in the AAA space. Those spreads, after being pretty high for a while, have really started to contract a little bit, but that tends to be 2 to 3% allocation to AAA CLOs. We might take that off. I mentioned when we talked about with Orchard and Paul, that also does fall in. We will do CLO stuff within the private credit portfolio too, in that corporate securitized bucket. And one other thing, we do quite a bit in hedge funds. We've got 40% in hedge funds. That's our portable alpha engine. We've got a line of credit against the hedge fund collateral. We always have a fair amount of undrawn capital. And I know it's been a while since we've seen a real event. We certainly saw one with COVID. But that's CLOs, like the mezz tranches or even the equity tranches, are some of my very favorite places to go when spreads really blow out. It's a great structure. We haven't seen the structure break too frequently, but there is a lot of mark-to-market risk, especially as you get down to the equity tranches, but that can be interesting in a drawdown. So thanks, Rick. All right, Anthony.
Thank you. So what I wanted to look at really was emerging markets fixed income and really the approach to actually making money in the asset class and making returns, because on the face of it, it's a pretty interesting asset class. It's $10 trillion of assets, so it's big, it's diversified, it's 80 different countries, 13 different sectors. It's, I'd say, under-researched, and so it's quite inefficient. Therefore, there should be a certain level of alpha there. And valuation-wise, I think if you look on a like-for-like basis, it does stack up normally pretty well versus developed markets, if you just look at traditional credit. So what are the problems that investors sort of have with the asset class? Often it comes down to the beta and the timing of entry into the asset class. And what I think a lot of it comes down to is the need to have indices, or investors want to have indices, which ultimately attract capital to the biggest issuers as opposed to attracting capital simply to the best issuers. And so, if I look at the performance at the index level of EM fixed income, actually for the last 5 years, it's not 10% or 20%, it's actually 0%. And that's largely because when you see some of these big beta drawdowns, it can come through things like FX. If you think of the 2013 taper tantrum or a lot of geopolitical events, a lot of risk-off periods, the dollar strength really kills emerging market currencies, makes it very difficult to achieve returns. And if you think of some of the geopolitics like Russia and Ukraine, that created a very big default rate in some of those countries. If you think about the China deleveraging experience, it created a huge default rate. 50% of Chinese property names defaulted over the last 5 years. So there are certainly challenges, but if you take a slightly different approach to looking at this asset class and you look at more of a alternative long-short credit approach, actually some of those events can be very interesting. Short positions in some of these names like real estate or through the default cycles can be actually where you make equity-like returns because you can have very low levels of recovery, but you can be short from quite high levels. So I think the short side of the book can be very, very interesting in terms of delivering diversified, uncorrelated or negatively correlated returns. And then on the long side of the book, I would say you want to find those which are very idiosyncratic. And there are some pretty interesting examples. If I look going forward at the rest of 2025, I think in dollar terms, I have countries like Ecuador, for example, yielding 15% going into a political event. I've got countries like Argentina yielding 11% going into a sharp normalization of the economy, potential lifting of capital controls. And when we think about the local markets, the problem is the dollar. The dollar has been on this huge bull run. If you ever have risk off, the dollar is very strong. But when you think of some countries like Egypt, for example, their local T-bills offer you 26% yields at the moment. In Turkey, you can pick up 29% yields in longer dated bonds in a country where inflation has come down from 60% 2 years ago, and it may end this year around 20%. So these are kind of structural trends which should mean that we can decorrelate a little bit from the dollar. You probably don't want to be just fully invested, but looking at more concentrated positions in these types of names, to me, makes a lot of sense. And where I mentioned and referenced the indices that had done zero, for us, a long-short approach has allowed us to harness the volatility and also the dispersion in the asset class. Because 80 different countries, why should Brazil necessarily be correlated to China or be correlated to Mexico? They're very, very different countries, different economies with different return drivers. So for us, our long-short credit has delivered over the last 5 years, which has been a particularly challenging time for EM, net returns upwards of 12%. So I think it does sort of justify the approach, and looking at best ideas on the longs, best ideas on the shorts can be a really powerful way to make returns in what is a pretty interesting asset class.
Delta's got a 10% targeted allocation to private credit. What does that mean to us? I mentioned the 5 buckets. We've got effectively direct lending. That's one. I already talked about the other bucket, which is corporate securitized. We also do residential lending. We do commercial real estate lending. We do asset-backed lending. That's what we've got. We are still a pension fund, so we've got 9% investment grade allocation. We've got 5% long duration investment grade. You kind of squeeze all this together, it's 25% of my capital, it's 20% of my risk. I expect the credit bucket to generate more than 1% of return on our path up to that 7 to 8%. But credit is meaningful to us. We're starting to wind down on the panel, 30 seconds each. Chris, we're going to start with you. Closing remarks, be it a contrarian trade, concern that you've got, or a trade for the audience to avoid in 2025.
I think with emerging markets, what's interesting actually is the US agenda at the moment, which is tariffs on one side, deregulation on the other, some immigration concerns. A lot of that is going to create volatility. There's some of those are going to be positive for EM. If you call a truce in Ukraine, for example, that's going to be a great thing for EM. But a lot of that's also going to be negative. But again, 80 different countries, it's just going to bring volatility. For us, that's going to be pretty interesting and actually increase the chances for us to be able to get some interesting trades on and make returns.
I'd probably say there's going to be a big pickup in inflows into CLO equity, because I don't think I'm the only one recognizing this setup. I think a contrarian thing is I'm not a huge, I don't fully buy into the big cap direct lending phenomenon. I think the world figured it out 30 years ago. You know, lenders just want to make a loan and distribute the risks to get the fees, and the borrowers just want the lowest rate and the loosest docs. That's broadly syndicated loans. So I think there's probably going to be a shift a little bit on the margin back to broadly syndicated loans now that that market is humming. There's almost an adverse selection too, and some of the stuff in the big cap. Middle market, I think, is there forever. It has been there forever, and it makes a lot of sense. But in the big cap, there's adverse selection where you go to that market now because you can't get your deal done in the broadly syndicated market. So I think there's going to be some hiccups, unexpected hiccups in the big cap direct lending space.
So by intent and design, Orchard does well when volatility is high and banks are under stress. Well, guess what? Volatility is high and it's going to get higher. Thank you, President Trump. And banks actually are globally under stress. So for us, we see this as the coming, golden age 3.0 for Orchard. What I wanted to do separately from that, if it's okay with you, is to push back on something a lot of journalists and even regulators are talking about in this attack on, shadow banking and private credit. It's a bunch of nonsense, okay? The top 30 banks in the world control 100 trillion in assets, and the banks in general control about 250 trillion in assets. So yes, private credit has grown from 500 billion to 1.8 trillion. I'm sounding like Biden now, getting my billions and trillions mixed up. But see, it's gone from 500 billion to 2 trillion. We're not even at like 2%.
Yeah.
Yes, when things grow quickly and if they get into retail, you have to be careful. But we all need to just push back on this sort of fake news that the end of the world is coming through shadow banking and private credit. I actually think it's quite the opposite.
All right, so real quick in the interest of time, we're watching a divergence in default rates between high yield and loans. Loan default rates have accelerated, they haven't plateaued. If rates stay high, that's a worry. If rates stay high and growth slows, that's a bigger worry. So it's just something to consider, I'd say loans and even into private credit.
All right, well, I do feel a little bit better. I still think 7 to 8% is going to be a challenge in 2025, but please help join me in thanking the panelists for some thought-provoking comments. Thank you, gentlemen, very much.